Welcome to 401k Rescue Strategy. And before you do anything else today, I want you to hear one sentence. The single most dangerous moment in your entire retirement journey is not the market crash. It is not inflation. It is not even running out of money. It is the 72-hour window right after you stop working, before you tell anyone you have retired. Because the moment that news gets out, every unfinished financial decision in your life gets buried under celebration, social pressure, and calendar chaos. And the decisions that do not get made in those first quiet weeks are the ones that will quietly cost your household hundreds of thousands of dollars over the next 20 to 30 years. Most people retire and immediately announce it. They post online, they call the family, they book the trip, they feel free. And in doing all of that, they walk straight past 10 structural upgrades that could have protected everything they spent decades building. Today, we are going to walk through all 10 of them. Here is the macro reality that most retirement content will never tell you directly. The financial decisions you make in the first 12 to 24 months of retirement are not just year-one decisions. They set the tax tone, the income tone, and the estate tone for the entire 3-decade run of your retirement. Every withdrawal, every insurance choice, every beneficiary form you do not update, it compounds. Not just financially, legally, and across generations. The Internal Revenue Code does not care whether you were celebrating when you made a suboptimal withdrawal. Required minimum distributions under current law begin at age 73, and they do not negotiate. Social Security provisional income thresholds are fixed. Medicare IRMAA surcharges are triggered by income decisions you make years before you ever see a medical bill. This is not a crisis. It is a window, a short one. And the investors who move quietly and deliberately through these 10 upgrades before they tell the world they are done working, those are the ones who look back a decade later and say they did it right. Upgrade 1. Your withdrawal strategy. While you were working, the financial question was simple. Save as much as possible and put it in the right accounts. The moment you retire, that question flips completely. Now the question becomes, which account do I pull from, in what order, and how much? Most retirees default to their traditional IRA or 401k because that is where the bulk of the money sits. But every dollar from those accounts is taxable income. It stacks with Social Security. It affects Medicare premiums, and it sets the tax trajectory for 30 years. Before you spend $1 of retirement savings, you need a written withdrawal plan, one that identifies which accounts fund year-one spending, which years offer a window for Roth conversions, and how to hold taxable income below the thresholds that trigger higher taxes and surcharges. This is the kind of plan our team of CPAs, tax strategists, and financial advisors builds together with you. Upgrade 2. Your health insurance. If you are retiring before 65, your employer coverage ends and you face a coverage gap before Medicare begins. Marketplace insurance through the Affordable Care Act still offers income-based premium subsidies. The withdrawal strategy from Upgrade 1 directly determines how much those subsidies are worth. With the right income structure, the savings over the gap years can run into the tens of thousands. You need to model this before your last day of work, not after. Upgrade 3. Your tax plan. And this is exactly where a coordinated team can make the biggest difference in your retirement. While you were working, tax planning meant maximizing 401k contributions. In retirement, it covers the next 25 to 30 years. The first year of retirement is when you establish the baseline. Bracket management, Roth conversion planning, capital gains harvesting, and IRMAA management all begin here. Most retirees do not look at this until they file their first retirement return in April, and by then the year's income decisions are already locked in. You want a CPA, a tax strategist, and a financial advisor all looking at your full picture together every year. That is how the wealthy do it. Now you can too. Upgrade 4. Your beneficiary designations. Most people set these forms when they first opened their 401k or IRA and have not looked at them since. A beneficiary designation overrides your will. It overrides your trust. An outdated form can route retirement assets to an ex-spouse, skip an intended heir, or generate a tax burden your heirs are completely unprepared for. Updating your designations takes approximately 30 minutes and costs nothing. It is one of the highest impact actions on this entire list, and one of the most consistently overlooked. Upgrade 5. Your estate documents. A will and a power of attorney drafted when your children were young and your financial picture looked entirely different are not the documents you need today. Retiring changes your income sources, your account structure, and your overall legal exposure. Your healthcare directive, your durable power of attorney, and any existing trust documents all need to reflect your current situation. Without updated documents, those decisions get made by courts and by whoever has the loudest voice in the room when it matters most. Upgrade 6. Your insurance coverage. The insurance portfolio you carried during your working years was structured around earned income, dependence, and working life liability. Disability coverage is no longer relevant once earned income is gone. Life insurance may no longer be necessary if your surviving spouse is financially secure. Carrying premiums on policies that no longer serve a purpose is a straightforward expense to eliminate. At the same time, umbrella liability insurance and long-term care planning become more important in retirement, not less. Right-sizing your insurance removes unnecessary cost and ensures the coverage you carry actually protects what matters at this stage. Upgrade 7. Your cash reserve. The conventional guidance of 3 to 6 months of emergency savings was built around the assumption that a paycheck was always coming. In retirement, that assumption is gone. A true retirement emergency reserve starts at 6 months of living expenses in something stable and liquid, and for many households, 12 months is more appropriate. Beyond that, any major known purchases in the first 2 to 3 years need to be identified and set aside before you begin drawing down your portfolio. Upgrade 8. Your actual spending number. Most people entering retirement have an estimate, not a number. In retirement, every dollar of spending comes from somewhere, and where it comes from determines your tax bill. Spending 3 to 6 months tracking your actual expenses before retirement gives you a real number. One-year withdrawal plan can be built around with precision. An estimate fed into a retirement calculator is not sufficient for a plan that needs to hold for 25 to 30 years. Upgrade 9. Your Social Security analysis. Selecting a claiming age based on the monthly benefit amount is not a Social Security strategy. The optimal claiming age depends on how that benefit interacts with your withdrawal plan, your Roth conversion timeline, your IRMAA exposure, and your provisional income calculation, which governs how much of your Social Security benefit is subject to federal income tax. The question is not which age produces the largest monthly payment. It is which claiming age creates the least overall tax damage and the most long-term flexibility. For most households, those are meaningfully different answers. Upgrade 10. Your survivor plan. A household that has saved diligently, paid off the home, and built a substantial traditional IRA balance can still leave a surviving spouse in a significantly worse tax position than the couple ever faced together. When one spouse passes, the survivor files as a single taxpayer. Single filer tax brackets are compressed. Required minimum distributions continue on the full traditional balance. Social Security provisional income thresholds drop sharply. IRMAA surcharges hit earlier and harder. For many couples, this is the clearest argument for accelerating Roth conversions while both spouses are alive and the brackets are still wider. Model this early, with a full team of professionals including your CPA, tax attorney, and financial advisor. Do not leave the surviving spouse to discover it alone. Here is what I want you to understand about the timing of all of this. The moment you announce that you have retired, the calendar fills. Trips get planned. Family gatherings get scheduled. Spending starts flowing before the structure is in place. Every one of these 10 upgrades requires clear thinking and protected time. That window, the quiet period running up to retirement and immediately after it, is short. It does not come back. The investors who handle these things first, before the celebration, before the social pressure, before the spending begins, they are the ones who look back a decade into retirement and say they feel genuinely secure. Not just because of the account balance, but because they made the foundational decisions correctly. Now, I want to be straight with you. Yes, when you withdraw money from a traditional 401k or IRA, you will pay taxes. That is the truth, and anyone who tells you otherwise is not being honest. But the real question is, how much and when? because there are legal, ethical ways to reduce that pain significantly. The wealthy have always known this. Now you can too. If this made you curious, click the link in the description to learn about the 401k rescue strategy. Answer a couple of quick questions and come to us. We will get all your questions answered. No obligation, no pressure, just a conversation. If it makes sense for you, great. If not, no problem. I will see you in the next one.